Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. This is the January 2026 episode. And as we do each year, I want to basically dedicate the episode to a review of a little bit the outlook we have for this coming year. We'll get into our normal check-in on markets and things, but interwoven will be this discussion around our outlook for the year. And in this year in our outlook report, we entitled the concept Rewiring Growth. So the title of the report is Outlook 2026, Rewiring Growth. If you want to check it out, you can go to stifelinsights.com. And as we do each year, basically, this is a compilation of a bunch of different articles. So there's a review of last year. There's, of course, our outlook framed up in an article. We once again have our colleague Brian Gardner, our Chief Washington Policy Strategist, talk about what's going on in Washington. We pen a couple of special articles. One this year is on our fiscal trajectory. And I'll talk a little bit about it. And then another is on artificial intelligence, which is really at the core of our discussion on our outlook. As ever, we have a few other things in there, really geopolitical risk framing and things like allocation insights, what all this means in terms of allocating money. So anyway, I want to jump into it, but just do sort of start by inviting you to check out the full report. And there's a video and a webinar replay and things like that. Anyway, let's kind of start with DC and geopolitics. So again, Brian Gardner penned a great article, and basically what we got into were sort of the state of things in DC in the context of some of the geopolitical activity, the idea that we're facing down a midterm election, and the potential for a divided government, which is not uncommon at the midterms. He kind of gets into the idea that affordability is a key focus for voters, basically, and so therefore a key focus for politicians, and kind of the implications for all this for the economy. Of course, he gets into trade and tariffs, changes at the Federal Reserve, and some other things. And I'll kind of get into some of his observations as we make our way through the discussion. Anyway, when it comes to geopolitics, again, the report includes an update to our geopolitical risk dashboard. Remember that we identify risks like U.S.-China competition, which is basically happening, but things like cyber attacks or Cold Wars, maybe structural changes that could lead to sustained higher inflation, things of that nature. Most of it we don't see happening currently, but we sort of gauge the likelihood of it, and mindful that there's all kinds of pockets of risk. Now, as we did about a year or so ago, we actually broke out the military conflicts into its own section. And of course, we have Russia, Ukraine, we have the tensions and issues in the Middle East, and we have recently then the Venezuela situation. And what I would say is we're mindful of the human cost, right, of these military conflicts, and that's always unfortunate. What we also try to do then is to take a step back and look at the economic and market implications. And so I would characterize the issues, the situations, and the risks out there as not really much impacting the global economy nor the markets. And so we look at it through the lens of essentially escalation and the worries that might come from that as it relates to markets and the economy. Of course, escalation would also have a human cost. So we try to be very, very mindful of that. In any event, point being that, while we see things like the Venezuela situation and there's all kinds of opinions about it, when it comes to the markets and maybe first order of the economy, we don't see a big negative impact. In any event, moving on to the economy, when we look back last year, I would say things ended up probably a little bit better than folks were anticipating, at least the emotion that was in the environment as we started the year. We saw the Fed ultimately cut 0.75 points We saw inflation cool, but still stay a little bit firm. So think about an annual rate of about 2.8%. Fed's target is 2. GDP growth was 2%, and that was after a negative first quarter. So one pattern we observed in the second and third quarters was that the consensus view ended up being more muted than what actually happened. And there's a possibility that happens in the fourth quarter. We're still awaiting the fourth quarter numbers, but the metrics, the indices that track that, are signaling the possibility of a number a little bit heavier or higher than consensus views. And if that happens, that 2% estimate for the year will probably go up somewhere between 2 and let's call it 2.5. Rates ended up being reasonably stable. And then the equity market, which I'll get into in a little bit more detail in a second, ended up having a good year. S&P 500, for example, almost 18%. So trend growth continues basically on the economy. The consumer, despite sort of softening confidence and sentiment, remains engaged, especially in the middle and upper income levels. The job market, even though we've seen some softening, remains at a level where we're close to full employment. And so, unemployment rate sits at about 4.4%, I think. And then we're seeing, a little bit of a firming in jobless claims and a little bit of a weakening in non-farm payrolls. But, the punchline is the job market's not falling off a cliff at all. And so, when we think about that, we think about the economy, we're seeing forecasts just a little bit more positive for the full year 2026. Consensus sits at 2.1, but it seems to be trending a little bit higher. And then when we look at inflation, while things bounce around a little bit, both the consumer price index and the producer price index have come down, in recent months, call it the last 3 to 6 months, all in all, reasonably close to the Fed's 2% target. And so ultimately, all that means to us is that, the Fed is sort of stuck looking at the dual mandate. Jobs were pretty close to full employment. Inflation seems to be coming down. And the Fed is signaling, hey, they're going to watch the data and not act super quickly. But we're calling for 1 to 2 cuts this year. And that's what futures are pricing in. I mentioned, I think, the idea of fiscal trajectory. So we do want to mention still that we operate at a deficit, and the current debt is growing, and we have officials all talking about the need to kind of get on a better path, both corporate leaders and government leaders. So in our article this year, we penned a piece called "Fiscal Trajectory: Borrowed Time," and basically we have 4 scenarios. I'm just going to quickly run through them. Baseline drift is the idea that we keep going where we are. It's managed imbalance, kicking the can down the road. It might feel okay for a while, but there will be a reckoning at some point. Discipline, stabilization, reform by necessity. Think of it as market forces, not overly dramatic, but still negative, that might prompt a focus on this by voters and ultimately elected officials. And we start to see a little bit of austerity, meaning lower spending, maybe a little bit higher taxes, try to help out. Crisis spiral, discipline through shock, would say, hey, the market reacts more quickly in a negative direction, forcing action that appears more abrupt. So austerity for sure, significant cuts in spending, significant increases in taxes, and that we see that scenario being related to a deep recession. And then the most optimistic of all is growth renaissance, a productive escape. Here the idea is, we still need to see some austerity. So, a reduction in the deficit, a work to try to get the debt, overall debt as a percent of GDP down. But that's helped by what we're actually calling for, which is an incremental increase in the GDP growth rate, call it in the neighborhood of 0.5%, that can, over time, make a real impact on this issue. And so the idea would be that we have austerity, but we also partly grow ourselves out of the issue, because what matters a lot is what the deficit and debt looks like as a percent of our economy, as a percent of GDP. Anyway, to get to our forecast for the year, we're basically calling for a little bit, probably more positive on the economy than consensus. We have a range of 1 3/4 to 2.5. So sort of the middle of that is a little bit above consensus. We think inflation's going to cool a little bit further. We think the Fed's, again, going to cut 1 to 2 times. And our forecast for the equity market, we always do the S&P 500, is for a 10% total return. When you do the math on that, that translates to a target at the end of the year of 74.50. And what I would say about that is, number one, right now the consensus view is that earnings growth will land between, call it 13 and 15% for the S&P companies. If that were to happen, to get to this price target, that would accommodate round numbers, about a 4% decline in price earnings ratio. So what's called PE has been a little bit elevated. So we're calling for that to soften a little bit off the back of still, very sort of healthy earnings growth. Now, talking about the markets more broadly, yields remain elevated. Yields on bonds remain attractive. So the fixed income market, I guess a good word to use for the role it plays, is it's been well behaved. And we expect that to continue in 2026. When it comes to the equity market, we've talked before about how the makeup of the market has leaned heavily into these big tech-oriented companies. And they represent, when we look at the S&P 500, a good chunk of the top 10 companies. And those companies together, the top 10, represent high 30% weight in the S&P 500. So their performance has a significant impact on that market performance. Now, when it comes to our outlook, for years we've been talking about long-term themes, things like productive competition and shifting demographics and securing strategic resources, the new consumer, fourth industrial revolution. And here, these days we kind of recognize that artificial intelligence is kind of woven through all of the innovation and positive things that are happening when it comes to the way the world's changing and growing. And so we penned another special article in our Outlook called Artificial Intelligence Runway for Growth. And the whole idea here is to say, look, we're identifying already very tangible examples: healthcare, let's say drug discovery, financials, fraud detection, real estate, tenant screening, consumer discretionary, maybe hyper-personalized commerce, industrials, quality control, or robot support, and then, of course, information technology, AI agents, software development, et cetera. AI is just sort of woven in, and we're seeing tangible ways it's being used to basically amplify growth in a more cost-effective way that's going to translate, in our view, to improved productivity that will in turn translate to both higher levels of GDP, but also supporting meaningful profit margins and earnings. All of that is an optimistic sort of backdrop to the markets. So we see profits continuing to stay healthy, earnings continuing to grow. And one thing I wanted to point out when it comes to performance on equities, looking back, is that last year was defined by some winners and then some laggards, still positive numbers, but laggards. So quickly, think of it as non-U.S. stocks, a little bit due to a weakening dollar, and then the big tech companies, I'll just say it very generally, earning returns in the 20 to 30% or more range for indices in those buckets. That cap-weighted effect, those big tech companies, meant that cap-weighted indices like the S&P outperformed the equal-weighted version. So, for example, with the S&P at almost 18%, the equal-weighted S&P was up a little over 11, still a good number, but not quite as good as the cap-weighted. It's very common for wealthy individuals and retail investors to invest in dividend-paying stocks and quality companies. So the dividend-paying stocks on a cap-weighted basis earned by the MSCI USA High Dividend Index 12%, so a little bit of a haircut. The S&P High Dividend, which is a little more high quality, earned 4.7%. And even in the small cap space, where the broad market was up over 11, the S&P 600 is up 6, and that's, again, a little bit more of a quality play in small cap. And then the S&P actually produces an index focused on quality, and believe it or not, that index was up only 1.3%. So, when you look at the high end, emerging markets up over 33%, and then by this framing, the low end, small cap quality companies up only a little over 1%. That folks that are invested in these various buckets may have a little bit of FOMO, meaning, I wish I was invested all in non-US or all in big tech. But what happens is these things rotate. The leaders become the laggards and vice versa. So we've been talking about this in the way of saying, look, don't chase performance. It often rotates. But be diversified. You should have exposure to all these different areas so that as they move around, you benefit from those that do well. And so, again, it's just an interesting and sort of wide-ranging market. We are calling for the market in 2026 to broaden out. And so this idea of staying the course will be pretty important. Anyway, I'll mention briefly that we do pen a couple scenarios beyond our base case, the bull case and the bear case. This year we did it against 3 concepts: AI monetization, the consumer, and policy. So with AI monetization, in a negative environment, maybe the investment in AI disappoints or things go more slowly than we expect. On the positive side, it becomes evident even more quickly that things are going to be super positive. With the consumer, the bear case would be the consumer. Something happens. Maybe it's an exogenous event. Maybe the job market weakens further and the consumer backs away. That would help fuel a bear case. Or on the other side, hey, we see real improvements in different things. Maybe a little more optimism. Animal spirits weigh in. Consumers get even more active. That would be the bull case. And then finally on policy, whether it's monetary or fiscal, when we see the Fed, it's sort of like they're trying to balance, cutting rates to help the job market, but not going too fast to make sure inflation doesn't resurge. In a bear case scenario, maybe there's a policy error. In the bull case, they do a great job. So again, just you could refer to the report for a little bit more detail on our 2 scenarios. Anyway, I just want to kind of close, as I always do, by pointing to stifelinsights.com. As it relates to our outlook, there's a report. There's this podcast. There's a corresponding couple of videos on it. There's actually a client webinar we had. And so I'd just invite you to check out stifelinsights.com, download a copy of the report, or ask your Stifel financial advisor for a physical copy. They're nicely done. And with that, I'll just break and say thanks so much for listening to this episode, and we will catch you on the next one.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.